Everybody, it's Michael Martin. Hope you're doing well. Sorry if I sound a little froggy this week. Was in New York City most of last week, and I think I picked something up on the way home on the plane. But it was good to be home, see everybody. I did a lot of fun stuff, a lot of new restaurants there. Spent a lot of time in Central Park. Of course, I went to the museums. I spent time in the Met and the MoMA. And it was great. It was good. It's muggy, it's different heat than LA. But anyway, I appreciate all the comments and the feedback that we're getting. Some of it is, you have really, really good questions. Sometimes I understand that the questions can come from two different places, right? Sometimes the questions can come from, let's just say, we're all ignorant, right? On some level. And other times you have folks who have deeply held beliefs. And when you challenge those beliefs, they take it as a personal attack, especially the 42 times, the day trading thing. And so that's why I like to focus on the data, because the data is not just irrefutable, it's testimony. And so if that's new for you, for some of you anyway, I've encouraged you to always look at the data and get away from looking at charts. I've encouraged you from, try to move away from just looking at stock index futures and day trading into longer time frames and look at other instruments. Because it's impossible for me to validate just trading one strategy on several correlated instruments. Although you can have some success, the opportunity cost with doing that is very, very high. So in my humble opinion, if you're going to be a short-term trader, at least look across several instruments and be a little promiscuous, because there might not be a setup for you. And in my opinion, if you're just starting out, I'd rather see you trade one setup across 12 different instruments than 12 different trades, none of which you're going to really be a master of on one instrument. Does that make sense? Because I think that's a better way to affect your edge. And if you don't have an edge, you shouldn't be putting risk on, at least in the near term. A lot of comments also came up on the video that we talked about embracing uncertainty. And what I want to talk briefly about is the concept of R. Like, what is your risk unit? Some people call it R. I tend to call it risk unit, but I think the majority of people probably refer to it as R. And so when I think about that, R is like a starting point as far as I'm concerned. Back in the day, the R was 2%, in some cases 5%. And at Commodities Corporation, the R was the entire account for the most part. They put their entire accounts in one particular name. Maybe not all at once, but they would definitely focus on one particular winner. And that's why they made, 10 to 20 times their money every year. There were certain circumstances where they had to get reloaded, but, ultimately you can trade as aggressively or not as you want, as it feels good for you. My R levels have changed over the years. And I think you can certainly adapt to different market environments to better reflect the volatility, for sure, and also directionless markets, right? So it can get a little sophisticated without some charts or some graphs. So I'm not going to go down that rabbit hole. But it's okay to change your R over time. I tend to would advise that you start small, and then you can always add. Because in dealing with the uncertainty part, of course, we're talking about how much are you comfortable losing, excuse me, and how quickly. Because at the end of the day, these markets are moving very, very sharply. And, 2 to 5% moves in the underlying instrument seems to be par for the course for the markets that we're in right now. And so you have to think, like, if you're stepping into, I know one person left a comment about, trading, 0.5%, 0.5% risk unit and having 15 losers in a row, so that's 7.5% drawdown. So you have to, at least from that particular standpoint. So you have to conjugate that with your emotional constitution. And in times like this, when the markets are in retraction mode and the stage 2 breakouts are stalling, bases are being formed, consolidation needs to occur, you might consider sitting on your hands or trading much smaller to take into account, what's going on in the marketplace right now. Of course, the best thing to do is to try to simulate it just to see if you can. I know simulation is harder for folks who are discretionary chart readers, but you can certainly get a lot out of looking at the data. And that study, Ganja and I are going to look at that. We'll look at that study on Wednesday, and I'll show you. This way you can see the numbers for yourself, and then maybe you could turn it into a trading rule if you wanted to. But what I wouldn't do is choose a R for one particular strategy and then change that over time, right? Because that's where you want your consistency to be, is in your risk unit, in being able to execute your plan day after day, period after period. So I would keep your R at a certain level that you can execute as far as being consistent, but then also not feel other feelings of regret if the move is in your favor and you feel like you don't have enough. Because I can assure you, when the market goes against you, you're going to feel really, really good when you trade smaller. Because, if you trade smaller and there's a sharp move against you, especially if you're using imaginary stops or mental stops, you could end up losing money for reasons that you shouldn't have. And that's part of the process of executing and learning how to do this from a practical standpoint. Is everything in your brain is ultimately theoretical until you start taking the actions, and then it becomes practice, right? You're putting it into practice, then it becomes behavioral. More people go on tilt because they've used mental stops that have gotten blown through, and then they find themselves in bad spots and they start to panic. So I think in a I don't want to make this a long-winded answer. My R has evolved. There are times when, again, if it depends where you are with experience. I think if you have a lot of experience, there's times when I know that the markets are super amenable to my trading style. So for the discretionary stuff, you can trade it a little stronger, especially if you have lots of realized and unrealized gains already booked in your account. You can start to determine, well, how much of that am I willing to risk, right, on this next trade, given what I have now know, right, because it's after the fact. But still, I'm going to stay adhering to the trading rules. You see what I'm saying? Now, systematized traders have a bit of a benefit because everything from entries to exits to position sizing stays constant, right? It's harder for the discretionary folks because they constantly, I think, have an opportunity to get sucked into trades, especially if they're in a drawdown and they want to dig out of that, which can kind of get lethal. But I don't think it's a sin if your R is adjusted. Further, and I'll conclude by saying this, some of you who have a lot of experience and you might be trading, say, more than one asset class, you might have an overnight R, you might have a during the day R, you might have a day trading, swing trading R, you might have a position trading or an options-based R, right? Because all those rules might be different, right? Even if it's discretionary, if you put those discretionary rules together, you can still say that they're somewhat systematic as long as you repeat them religiously over and over and over again. But that comes with time. That comes with lots of practice. I wouldn't advocate, at least you might not agree with me, but at least I'm consistent. I tried to do everything under the sun when I started, and I didn't make any progress. So I had to peel back and focus on executing one thing and finding success in one area, and then building on top of that, which you can do it too, right? Because I've proven it can be done. How you get there might be a very different path than the one that I took, but it is doable. And so that's all I want to say about that. If you're starting out, I would adhere to one percentage for your R. until you have a year or two under your belt where you know that the results are now in your favor. Those rules that you follow have positive expected value. All you need is one bad trade because your R was too big to lose all the money that you've earned in the year. And that's not a spot where you want to be. Now, if you're making big money and you can constantly reload your account, then you might be trading more for the excitement than for the professional aspects of it. But I'm not here to judge anybody. It all comes through, it's all a learning process for you. So, but at any rate, be mindful of what your R is. I would start at a lower level and then work my way up. And then I'd also be mindful of the fact that as the markets become more volatile, right? Even if you're risking, you want to make sure that the number of contracts or the number of shares that you're trading are inversely related, right? Because as the volatility goes higher, you'll need to trade smaller. And that's not really what people come to me, right? I don't think I've gotten a single email saying, man, I want to scale down. Almost everyone who's starting out wants to scale up. But I think it's the mark of a pro to know when to scale down. So typically there's an inverse relationship. But as volatility goes higher, your position sizes go down. So chew on that for a while. We'll be back tomorrow. Again, I'll have Ganja on Wednesday. Sorry about my voice, folks, but I'm doing the best I can. See you tomorrow. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.